one of the best and most underrated investors of all time, just broke his silence. After years of not commenting on the stock market publicly, Baupost Group founder Seth Klarman made not just one public appearance, but two, as he appeared on both CNBC and on an investing podcast with host Jim Grant. And some of the comments he made are at the same time both scary and encouraging. So in this video, I'll break down both the good and the bad news that Seth Klarman was sharing with investors. And so without further ado, let's get right into it. Okay, let me start right away. I'm going to share two good news and two bad news, and I urge you to stick around until I get to aspect number 3, as I think this forecast, or if it's maybe not a forecast, it's at least a concern that Klarman expressed. Well, I think it's something that all investors should be aware of. Okay, let me start with one not so good news. So Klarman just appeared on a podcast show titled Grant's Current Yield Podcast. And on it, he highlighted that after the significant correction of stock markets in 2022, and I guess you can say in the US tech sector in particular, we're back to elevated valuation levels. And as a matter of fact, high stock valuations will lead to lower future expected returns for investors, which Klarman also pointed out by saying, quote unquote, the best periods to invest are when you enter at low valuation, and the worst are when you enter at high valuation. And later he said, this is a market of stretched valuation again. The market is once again over 20 times earnings, and a number of stocks stand out for very extended valuations. So the risk is out there and investors should be aware. And we can back up what Klarman just said with some data. So the S&P 500's price to earnings multiple is back to 26 times earnings. The Shiller PE ratio, which divides the price by the average of 10 years of earnings adjusted for inflation, is even higher and stands at 31 times. And as this graph here, that looked at the period between 1995 and 2020, shows, expected future returns before inflation are not particularly great from this starting point. And I think some of the individual stocks that Klarman had in mind when he was talking about specific individual stocks that trade at much richer valuations are many of the AI names like Nvidia, but maybe also stocks like Tesla. But then there's some good news too. At the same time, Klarman highlighted that, quote unquote, with the significant correction of 2022, there's less overvaluation in parts and sectors of the markets, and it wouldn't surprise me to see this continue. And later he said, we're finding more and more to do. And I think what he means here is find more attractively valued stocks to invest in. It's a very exciting period. You may have headline indices hitting bull market levels again after the bear market of last year, and valuations not seeming cheap, but underneath the aggregates, there are a lot of individual situations that seem attractive. Okay, and while I think those comments by Klarman are a little harder to back up by data because we would have to look at individual stocks, and I really don't want to recommend individual securities on this channel, let me point out two things. First of all, I am fully invested as I actually see multiple attractive opportunities to deploy my capital into individual stocks. I can only urge you to look hard enough. And second of all, one might point out the divergence between the large cap indices like the S&P 500 and small cap indices, like for example the Russell 2000, which is predominantly made up of small cap US companies. If you look at this graph here, ever since 2019, the Russell 2000 is lagging the S&P by quite a margin, underperforming by more than 60%. And historically, we've never seen such a wide spread. So I think especially in the small cap world, which is where you as an individual investor can go hunting, there are certainly opportunities. Okay, let's get back to the bad news. The second bad news that Klarman shared with the listeners of the podcast is that Klarman is deeply worried. He's deeply worried about the consequences of the low interest rate environment and money printing that followed the great financial crisis of 2008 and that maybe accelerated during the COVID pandemic. And that's because he expects interest rates to stay at a more normal level from a historical perspective, and he's unsure of the consequences of this, you could maybe call it a regime shift. Let me just show you a short clip from the podcast here.
What I can tell you is I'm deeply worried about the effect of higher rates. That the world got used to low rates. It became a habit The same amount of debt seemed less of a problem at very low rates. And one of the biggest borrowers that benefited from the low rate environment and the availability of easy money to everyone were some of the less developed countries. And it's just on a global basis, the debt across countries, I think maybe every country except Greece has a higher debt to GDP ratio now than they've had at almost any other time, or for some of them certainly more than they've had at any time in their histories. I imagine that could blow up in a very concerning way for the global economy and for the unsuspecting people in these countries. And frankly, all the way to the most developed countries. You see debt to GDP literally rising everywhere. And it seems plausible that we will not be returning to zero rates. We will have a series of a lengthy period of rates being restored to more like historic levels. And that's going to play havoc with all kinds of things, including all the way up to the stability of the entire global system, given how dependent we are on the United States.
Okay, so I think Jerome Powell has actually done a fabulous job so far fighting inflation. The US inflation rate came down to 3% in June, which makes you inclined to think that the Fed will, at least for now, pause hiking interest rates going forward. But we also know from history that inflation can be tricky to deal with. Sometimes you think you already defeated it, only to see that inflation will shoot up again. So whether the more recent cool down of inflation is really sustainable certainly remains to be seen. And Klarman also said that he's not sure what the impact of higher rates, so rates maybe in the 5% range, will do to corporate profits. But I think what you can be certain of is if you invest in low debt and high quality companies, ideally with pricing powers, I think these companies can and will do well in all sorts of macroeconomic environments. Okay, and now let's take a look at another positive note that Klarman made. Klarman was also asked to comment on whether he thinks markets are more efficient nowadays compared to when he started, which obviously would make the stock picking game harder for investors in the current environment. And Klarman clearly thinks that while markets might have become a little more efficient, he's also aware of the fact that market participants have become much more short-term oriented. This is, for example, reflected in this graph here, which shows the average holding periods at the New York Stock Exchange. And the average holding period is down from 7 years in the 1960s to just a few months. So let me show you what exactly Klarman said on CNBC.
Do you think that opportunity that you had in 1979 still exists in 2023?
Andrew, it's such a great question. I think that markets can become more efficient. And there's a question in my mind about once a market becomes more efficient, whether it actually does have the likelihood of becoming less efficient afterwards. So for sure, there's more money in public markets, things have become somewhat more efficient. But I also see a short-term orientation that tells me that it's possible some pricing has actually become less efficient. I think when you look at Meta, the stock's been all over the place in a reasonably short period of time, falling to under 100 and then rising back up to almost 300, literally months apart, for a large, well-established company that I think everybody can analyze. So I think that there are opportunities. Now, if a kid came to me and said, where do you think I should potentially make my career, I would encourage them to look for the most inefficient pockets in the world. I also think it's important that they get mentored, that most people aren't ready to just jump right into this business right out of school.
Okay, let me just say one thing right away. I 100% agree with Klarman that you should only invest actively if you actually know what you're doing. And he's absolutely right that a great way to learn the art of investing is to get mentored. So if this is something that you would be interested in, I urge you to take a look at the description box down below. So the example that Klarman chose here is the stock of Meta, one of the biggest and most widely followed companies in the world. And yet the price of this multi-billion-dollar business has been fluctuating very wildly over the last few months and actually over the last few years as well. More recently, Meta stock was down some 70%, at one point trading below 10 times its free cash flow, and now is up more than 3 times from the low set in last year. So let me ask you, does this look like an efficient market to you? I don't think so. So I think the stock of matter is just one of many examples that shows that at least at times markets are still inefficient, and they can be highly inefficient, giving the intelligent investors, those who know what they are doing and that know how to actually value businesses, opportunities. All right, and if you like what I'm doing here, you should absolutely check out the following video next to learn more about the art of valuation and the overvaluation of the stock of Nvidia in particular. Take care.